Hi, Tom. So, what we're going to be talking about in these series of topics for this week number 6 is cash flow, differential analysis, and decision analysis pharmacoeconomics. I have posted multiple readings, a couple of video vignettes under the cash flow section with Olin Sykes, and for this week the assignment is really basically to read these, watch the videos, and reflect on the questions I posted on the discussion board. When we meet, we will talk about this. We'll also talk about setting a date for your business plan because I know with the current environment, things have kind of got upheaved. But what I hope to when we do talk and meet, that we can kind of go over some of these scenarios and answer any questions for you. But there's only going to be three tape lectures: cash flow, differential analysis, and I combined the pharmacoeconomics with decision analysis. And so we've talked before when we talked about break-even analysis, and we talked about financial statements in the past. Is that this is no different, and we've kind of talked about some of these topics, but cash, and even in like today's environment, what's going on with everything with businesses and the stop of businesses, cash is the lifeblood of our business. It's how we pay bills. It's how we make changes to our business. It's how we make our payroll, pay our employees, and pay ourselves. But knowing how much cash we have is not readily available to managers because most of the time, what do we have? We have an income statement and a balance sheet. And the balance sheet and income statement can show that we're highly profitable, but when we go to our bank account to write a check to pay our bills, we see we have no cash. And that's the problem with an income statement and balance sheet. Income and balance sheets prepare us for, they're prepared by using accrual basis of accounting. So what does that mean? That means revenue is recorded immediately when a sale is made, not when we receive cash. And in today's society where, we are using credit cards, we're being paid, by third party payers, and 90 some percent of our business is from third parties, we're not seeing that cash right away. Expenses are recorded when they are incurred, not when payment is made. So we're buying inventory and we are then paying our wholesaler at the end of the month or every 30-day dating. And so we're not seeing that cash removed right away in situations. And that's the problem we have with the income and balance sheet. So for example, in this example, in 2006, the total sales for this pharmacy business was 37 million 250,000. The pharmacies have, though, accounts receivable. And so therefore total sales would not be the same as the amount of cash taken in during that year because we are waiting to get paid and we don't always get paid on a timely basis. Total cost of goods sold for 2006 was 26,800,000. Cost of the merchandise sold, not the amount of cash spent on the inventory to credit purchases, the extent of inventory increase or decrease. And so, although there is a cost there, that is not necessarily what is going out. Total operating expenses include things like income tax, which is paid on a yearly basis and does not represent the amount of cash paid out to credit purchases and some expenses. We also depreciate capital expenditures, and those are designed to help lower our net income to save us on taxes, but therefore that is not always necessarily representing of what cash we have. So the statements of cash flow can complement an accrual-based income statement by providing information on the company's cash flow from operating, investing, and financing activities. These are also important for companies that, trade. They're important for stockholders. They're important for creditors to see how much potential cash you have to pay them in during the tough times. And they're obviously very important for managers and owners. The purpose of cash flow statements are they summarize the entity of cash receipts and cash payments during the period from operating investment activities and financing activities. The cash flow statements report the changes of cash over a period of time and explain those changes, and it assesses how well a company handles their cash. We need to look at what the true definition of cash equivalents are. Things that can be readily converted into cash. That that something is usually something we can convert in cash in 3 months or less. So if we have short-term bonds, money market accounts, and those things are cash equivalents. We also have to look at our operating activities. How well are we collecting payment from customers that have personal accounts? How well are we paying our suppliers for inventory on time? What does our payroll expenditures look like? And what is our taxes that we have to pay out? We also may look at our investing activities concerned with the acquisition of long-term assets. And so, what does our cash look like to be able to do large capital expenditures? Do we have cash to maybe acquire another business, to sell? Are we able, even if we're going to sell our company or an asset of our company, that doesn't always happen within a 3-month time period. The other thing we need to look at is activities concerned with raising and repaying of funds in the form of debt and equity. And so we have to look at our stocks or bonds, our payment dividends. And so in making a cash flow statement, we would use the balance sheet and the income statement to be able to determine that. And what we do in making a cash flow statement, we look at our sources of cash. We look at how much we actually have in the bank. We look at our net income plus our depreciation, because that depreciation may not be on this year of the books, and so technically that is cash. We may look at how much the owner is investing into the company, and how much are we saving in discounts for prepaid expenses, and so that is our sources of cash. Our uses of cash is obviously our accounts receivable waiting to be paid, our increase in inventory of having to pay out inventory, paying our bills and our expenses, and our long-term debt. So, in using these cash flow statements, we have to answer 3 important questions as pharmacy managers. What were the pharmacy's major sources and uses of cash for this year? Were the major uses of cash financed by suitable and appropriate sources? For the year, was the pharmacy a net user or a provider of cash? So as I said, major sources of cash are net income plus depreciation plus owner's investment. Major uses of cash is purchases of property, product and equipment. Our increase in our accounts receivable and inventory. A well-run pharmacy's major source of cash would be profitable operations. Poorly run sources of cash are borrowing, selling fixed assets, and the owners having to reinvest their own money into the company. So a general rule in the dealing of cash: short-term uses should be financed by short-term sources, such as sales. Long-term uses should be funded by long-term sources, such as investments of net income into, long-term assets. So using long-term sources to finance short-term uses or vice versa may cause cash flow problems. What are some long-term sources? Net income plus depreciation. So our profit plus the savings of taxes by depreciation. Our owner's investment. Increase in long-term debt. And net cash from the sales of fixed assets. Long-term uses are net losses, owner withdrawals, decrease in long-term debt, and purchasing of expenditures on fixed assets. Short-term sources is increasing current liabilities such as accounts receivable, and obviously a decrease in current assets that we can liquidate. Short-term uses and an increase in current assets and a decrease in current liabilities. So poorly run businesses should not do short-term loans to finance, for example, a long-term asset such as an owner's withdrawal. Long-term loans should not be done to purchase inventory, because this is an example of just somebody using a credit card to buy groceries. is that if you don't have the cash, you're going to be paying interest on something you don't even longer possess. So, for example, Good Care Pharmacy's long-term sources in 2006 was around 4,780,000, and that is the net income plus depreciation. Good Care Pharmacy's long-term uses was around 3,280,000, 3,280,000, and that's from a decreased long-term debt and a purchase of fixed assets. And so, what does this statement of cash indicate? It indicates long-term uses are financed by long-term sources, that is good. Source statement indicates that short-term uses were financed by long-term sources. That is not good, just as we talked about. Except there's some divergence of the rule is acceptable if there's two conditions that are met. All long-term uses are financed by long-term sources, and long-term sources consist primarily of cash generated by operations and not by long-term borrowing. There's also two additional problems that appear here. There's a large increase in accounts receivable. And so if accounts receivable is greater than an increase in sales, that means we don't have anybody paying us. We are making sales, but everybody's charging. We may also have an increase in inventory, that we have an increase greater than the increase in sales, and we need to start asking why. Are we not tough enough in collecting? Are we a little bit too lenient on what people's charge limits are? Are we not getting paid by our third-party payers? And also, do we have not a way to manage our inventory? And so, because of all these things that occurred in this 2006 year, cash accounts decreased by 10,000. So they used more cash than generated for the year. So how would a pharmacy like this turn themselves around? Well, let's look at the simple cash flow cycle. We have sales. Hopefully we get cash from those sales, and we use that cash to purchase inventory. And obviously the ultimate goal, as in any business, is our sales are greater than our purchases that lead to net positive profit income. So the basics of improving cash flow is decreasing the amount of cash that's invested in the pharmacy, such as inventory. Slow the amount and rate of cash flowing out of the pharmacy, controlling our expenses, and increasing the amount and rate of cash flowing in, improving our accounts receivable, increasing our sales. And so a realistic cash flow cycle not only focuses on the cash sales inventory, but we have to think about accounts receivable, which then can be turned into, which is current, liabilities that can be turned into cash. And then we also have the ability to pay. If we have the ability to pay with cash, we're not taking out any long-term debt to help pay for short-term, debt. And accounts payable, if we pay on time, we may get discounts, and the cycle goes on and on. So the ways we can do this in the community pharmacy is controlling inventory, maintaining gross profit margin, which is not always easy in today's world where third-party contracts are telling you take it or leave it. Do we have the ability to take some cash and invest it? How well do we properly control our accounts receivable? One of the biggest tips you can do in having a pharmacy business is get away from personal charge accounts. You should have the ability to acquire a credit card, and the amount of time that you invest in mailing out bills, things like that. And some pharmacies that you acquire or maybe you're part of has it, but what they should do is kind of have a grandfather cutoff clause that everybody that was part of this program as of this date can continue. Any new customers cannot have that. And what you need to do with those old customers, anybody that is way overdue, you need to shut them off and discontinue them out of the program too, because that is just hurting your cash flow and not helping your business. It may make your income statement look nice, but it does not help. The other thing is how well do we purchase and how well do we pay to take advantage of discounts. And we're not paying interest on not paying our wholesaler, which can also add, just like somebody's personal credit card. And we need to minimize operating expense. So the biggest one, as we've talked about before, is inventory. As I showed you when you came to visit, as David showed you when you came to visit our operations, and we're not perfect from it, but inventory size, inventory quality, monitoring inventory. Do you have a perpetual? Are you evaluating different seasonal things of our inventory? And then the other one to take into account is shrinkage. Is there any theft going on? How do you monitor theft? Do you have security cameras? Do you have that everybody, how many people have access to the inventory? Not that you hope that you have run a good business and you're hiring honest people, but shrinkage can play a big role. I know not several, unfortunately, I know two people who in the industry who discovered employees that were stealing lottery tickets from them, which when they finally discovered it, it was thousands and thousands of dollars. And unfortunately, they recoup some of the cost, but not. That's another thing when you're purchasing insurance, is purchasing loss insurance. And do you have enough of that in case you have an employee that steals from you? So all of those things are important in inventory control. Maintaining adequate gross margin. Obviously, we don't have a lot of say in selection with third-party contracts, but this is where, when you listen to the differential analysis lecture, is determining, do I become part of a preferred pharmacy network or do I not? Is there high-end products I might be able to sell that supplement? Like, for example, maybe I do Medicare B and I do glucose meters and strips, but maybe I can't afford to carry One Touch because I don't get reimbursed adequately from Medicare, and so I carry maybe another off brand that is just as effective as One Touch but a better margin for me. Those play a role. If I get into MedSync, am I focusing on my high margin patients that are they getting their prescriptions filled every month? These play a big role in helping maintain an adequate gross margin. Are we reconciling our third party claims? Do we use a company to help that? Are there times where maybe the third party didn't pay us a check? Are we evaluating, are we billing appropriately? Sometimes, third parties are not calling you if you underbill them. Are we putting in the right amount, day supply, especially package size things such as inhalers, insulins. Sometimes, we might put in the wrong size and we get underpaid. Are we taking advantage of price increases? A lot of times third-party payers do not increase their price reimbursement till the end of the month. You usually have 45 days to rebill, and sometimes you can recoup some of that loss by going back and rebilling. How do you get into this? There's companies that can help you look out for that, but also maybe, running reports, especially when you see a price increase, getting that in. Billing on time and controlling your costs can also help that. How well you purchase obviously can improve your gross margin too. Investing idle cash. So for example, Cashmo Pharmacy has a balance of $25,000 in a cash account, but they really only need a balance about $5,000 a month to make payroll and to make expenses. And so maybe they basically take that remaining $20,000 and invest it in a short money market account. But they still wanted that they can liquid asset as quick as possible in case they need it. And so, some pharmacies owners I've known help use excess cash to project drug product price increases. And so a lot of times in the first of the year, we see significant price increases. And so I've known some pharmacies that will spec buy and buy more product in November and December and offset, that price increase by having a lower product they paid for, but getting a higher margin during the time of January and February. Another big one, as I said earlier, is minimizing personal account receivables. There's an example in the chapter on improving cash flow, is that if a pharmacy had $50,000 in accounts receivable, that's a long-term debt they've already invested. If they would have taken that $50,000 and maybe put it into like a long-term bond that pays 12% annually, they could have made at least $500 per month instead of investing in a credit program. As I said, credit accounts receivable slows the rate of cash. And there's a lot of operating costs, such as mailing out the bills, having one employee do that, sending out letters. Those all are costs. And then the other one is monitoring your accounts receivable with your third party payers. Are they paying on time? Or, every once in a while there's a check missed. So really important. The other one is the timing of purchases and payments. All right. Obviously you want to pay, soon enough to get the cash discount, but not too soon. The other thing too is maybe, by doing MedSync, you can control your workflow and determine when you purchase things. So for example, if a pharmacy orders on June 24th of the month and the bill will be sent the next day, and then you have $30 to pay. But maybe you have a product the patient is not due till the 28th of the month to get the prescription, and they get it once a month, and so you wait and you purchase it on the 26th instead. Then that bill will not be sent until the 25th of July, and the pharmacy now has 59 days to pay. These are all examples of how to improve cash flow, but it's so important that just one doesn't always solve the problem. And unfortunately, the other one I'm sorry, I skipped one, is decrease in expenses. And obviously, maybe you can renegotiate your lease. How one of the things we did when we purchased our new pharmacy software a couple years ago, yes, that was an initial capital expenditure investment, but what we saved in support costs with the new pharmacy company versus our old, we saved about $10,000 in just 1 year. Your deliveries, do you deliver every day? Do you have some type of schedule way that maybe you deliver to certain geographic regions on certain days? Can you med sync people based on geographic region? Those are ways to offset delivery costs. Always reevaluate your phone expense and your internet expense. Those programs change every day, and you may see some savings there, because the last expense you don't want to have to do is lay people off. But you always want to look at what is your percentage of salary to your total sales, and you always have to play that role in evaluating, which is probably the hardest role out of all of these expenses. And so this is lots of examples of cash flow improvement. They're not, a quick, easy answer. They're usually a combination of multiple things I've discussed. But please feel free in your discussion questions to talk to me about it, and we'll, discuss when we talk live. Thank you, Tom.